Hi, this is Alessio Rostani. In this particular video, we're going to talk about how you can make money in a stock market crash. In other words, how you can profit from a falling stock market. Now, if you think about the times in the past when you may have lost money because you bought a stock and the stock went down in price, and maybe you made some losses, well, this is your chance. So listen up. So what I'm going to do first of all is talk about the law of opposites. And this is actually quite simple to understand, but it is important to cover it first. First of all, the law of opposites simply says, look, if you're buying a stock, in other words, if you're entering the market, okay, then to exit, you need to sell. So obviously that's the way it normally works, right? So we're talking about the classic, buy low, right, and then sell high. Okay, so when the stock goes up, all right, then you sell. So that's the normal way it's done. So you buy to enter and you sell to exit. The opposite way, which we're going to talk about today in this video, is you sell high, but you buy low. Okay, so in this case, you sell to enter, but you buy to exit. All right. Now, again, if this may sound strange to you, don't worry. We're going to talk about this in much more detail right now. Okay, so the example I'm going to use for I'm going to give you a very simple example using a car as to how this mechanism works. Okay, so if you already know something about selling short, just bear with me because I am going to talk about it in much more detail in a second. So let's say your friend, your best friend maybe, is going to he's going on a trip to the Bahamas. He's going on a holiday to the Bahamas, and he says to you, "Listen, I bought this brand new Mercedes just very recently, and could you look after it for me while I'm away in the Bahamas for 6 months?" And you say, yes, of course. Now he goes on his holiday. While he's away, what you're going to do immediately is you're going to sell his car. Now I know that's probably is morally incorrect, but let's just go with this example. You sell his car for $100,000. Just keep the figures simple, okay? I'm not going to go into how much a Mercedes is going to go for, but listen, just say you're going to sell it for $100,000. You keep the $100,000 safely in a bank. Okay, you don't touch it. Now, 6 months later, your friend, well, he calls you up and says, "Hey, I'm coming back. You got my car ready?" And you say, "Yeah, I do." So he's coming back. You need to return the car back to your friend. So what do? You go back to the original buyer, the person you sold it to, and you buy the car back from him. Okay? But guess what? The car is now 6 months old. It's being used. It's not a brand new car anymore. So how much do you think you're going to pay for that car? It's not going to be $100,000, right? So the car is obviously depreciated in value. Okay, it's come down in value. You buy it back, let's just say for $85,000. Okay, just go with me here. Okay, so let's say you buy it at a much lower price at $85,000. So what you're going to do is you got the car back. Okay, you have the car back. So you're going to return the car back to your friend. He's happy. He's got his car back. But how much have you just made here? Well, you just made the difference because you have pocketed the difference from the amount you sold it and from the amount you bought it back for it at a much cheaper price, which means essentially you just profited for $15,000 for a car you did not own. Okay, do you understand the significance of this? So quite simply, guys, the steps for selling short are very similar. Okay, I'm going to explain it to you. You see, how it works when you sell short a stock is your broker lends you the stock, and that comes from the brokerage's own inventory. Okay, so your broker lends you the stock, then the broker asks you for a deposit to cover the value of the stock as a collateral. Now, just bear with me. I'm going to give you an example. I know this, you may be reading this saying, "Oh, this is kind of boring," right? Now, listen, I'm going to give you an example in a second. Okay, so you sell the stock to the market at a higher price. Okay, in this case, remember, you sell high at a higher price. And then when the stock drops in value, you buy it back at a much cheaper price, at a discount. Okay, and then you give the stock back to your broker. Okay, so I hope that's kind of clear. And obviously, you pocket the difference. Let's just go with an example here so you can fully see this mechanism in action. Okay, so now I'm going to show you a very simple example using Ford Motor Company's shares, their stock, as an example. This is what you see here, guys, is in fact the stock of Ford Motor during the last economic crash, the last recession we had of course, and you can see that the stock price fell from their highs in May of 2008 at $8 all the way to $2. Okay, so the way this mechanism works is, just to give you this example, and then just keeping it very simple. Your broker lends you 1,000 shares of Ford. So you say, hey, I want to borrow 1,000 shares of Ford at that higher price. So you've done your homework, and you suspect that the shares of Ford are in trouble. Okay, and maybe you've seen a signal or a pattern on the stocks of Ford. Okay, so what you're doing is your broker lends you 1,000 shares of Ford at what price? At $8. Your broker, therefore, will require a deposit from you. In this case, $8,000. So that's why, because it's $8 times 1,000 shares. Okay. You then sell the Ford shares. You sell the stock at $8. Okay, $8 per share. Okay. So now you have $8,000. You sell it at the market. Now the Ford stock obviously drops in value, as you can see, just like the Mercedes example we showed. The Mercedes depreciated in value. It went lower in value. In this case, Ford stock is dropping and crashing in value, as you can see. So when its stock price drops, you can then buy it back at a much lower price. Okay, just like we bought back the Mercedes at a much lower price. In this case, we're buying Ford back at a much lower price. Okay, remember, we're doing this now to return the stock back to our broker. Okay, just like you returned a car to your friend. All right, so you buy it back, but hang on a second here. You're buying it back not at $8 per share. You're buying this at a discount. In this case, $2 per share. Okay, so how much are you actually paying for those shares? You're paying $2 times 1,000. In other words, $2,000. So now you return the shares, you return the stock to your broker. He's happy. But how much have you just made? You've pocketed the difference. So you profited $6,000 in 5 months, which is 75% return from a stock you did not own. All right? And I hope that was very simple to understand. Okay, now I'm going to show you how this mechanism would have worked for Bank of America shares during the last recession we had, of course. So notice that the stock price of Bank of America plummeted in the last recession we had in 2008 from $55 all the way down to, well, the lows of $5, $4, and $3. Okay, you can see that. So how this would have worked is your broker lends you BAC shares. You call up your broker, you ask him to borrow those shares. So let's say you borrow it at the price of $50 per share, 50, and you're borrowing, again, 100 shares, okay, 100 stock. So that means he will require from you $5,000 as a deposit, as a collateral. Okay. Then what you do is you sell those shares which you borrowed. You sell them at the market. Okay, sell them obviously for $5,000. Okay, $5,000. Again, it is quite difficult to write with this mouse, as you can see here. But the point I'm trying to make is when the stock then falls in value, just like the Mercedes we just looked at, just like the Mercedes depreciated in value, went down in value. Here you can see Bank of American shares are falling in value. Then what you do is you buy it back at a cheaper price. You buy it back, okay, buy it back for how much? $5. 5 times how many shares? Well, how many stock do we borrow? About 100, okay? So you buy it back for $500. Okay, which means here you're pocketing the difference. In this case, how much? So you're pocketing, well, what's $5,000 minus $500? So we're talking about you're pocketing $4,500. Okay? And let me show you another example. In this case, the stock of Stearns, which, as you may remember, Stearns collapsed in March 2008. Notice what happened here. Again, just very quickly. Stock. Now, again, what you're doing here is you've got to do your homework. What I'm saying here, guys, you can't just gamble, just guess when the market's going to fall. You're doing your homework. You've seen a signal on that market. So here, the Stearns stock was at $75. Okay, 75. Again, let's say you're selling short 100 shares of them. So 75 times 100. Okay, at the market. So that's $7,500. Then Stearns stock falls in value all the way down to $4, right? And of course, as we know, Stearns actually went bankrupt here. So $4 and times 100, which means you buy it back for $400. So you initially you sold it. Again, you remember you borrowed the stock and you sold it for $7,500, and you're buying it back at a discount, a much lower discount of $4, which in this case you're talking about almost a 97% return here. Okay, that other one we just talked about on BAC, on Bank of America, that was a 90% return. So I hope that you understand now the value of selling short, and it is not immoral. You know, people say, "Oh, selling short is immoral." It is not. I'm going to explain to you in later articles and videos why it is not. It's important. Oh, and before you go, how did you find this article and this video? If you're watching this on YouTube, then please leave me your comments below the video. Tell me if you found it useful, did it help you in any way? And if you're seeing it on my blog or reading it on my blog, then please leave me your comments below the blog post. I'd really appreciate that. You can also, if you want to see more articles from me, like this one, you can subscribe to my RSS feed, or you can also actually subscribe to my trading alerts by going to here. Okay. Thank you very much.